Hey, Keith here for Am I Rich, and today we're going to talk about my view on what wealth is and how it might apply to stocks, and potentially some ways you could use that viewpoint of wealth to improve investing. So, what is wealth? The way I see it is there's many points of view of what wealth is, and I don't know that there is a valid one over the other. I mean, I have my view. I think is more valid because it's my view. But being unbiased, I don't. It's really something that just people will choose on their own. And I think this is how the human mind works. This is just like the brain allows people to have the same set of facts, but they'll still see some concept a little bit different than the next person, or have a little bit different idea of what it really means. So wealth might, for some people, might be having all the gold in the world. Being wealthy might be living your lifestyle like in a rap video. But the way I kind of see wealth is probably more along the lines of what Adam Smith in his novel set of The Wealth of Nations kind of described. So he didn't really state it directly in his books. He kind of described it over 5 really long novels. Great books, not such a great read. Even the audiobook's a little bit meh. But anyways, his concepts are really, really popular still. And so the way he saw wealth, and maybe I'm kind of skewing a little bit towards my own personal view, but generally speaking, the idea of wealth is if you have goals and desires or needs in life, the easier or more efficient you can get those, then your wealth is increased. And this applies to nations as well. His book, he'd always talk about like how England and France were trying to protect certain jobs in their own countries, but England could produce sheep products better or more efficiently than France could, and France could produce wine more efficiently than England. And so his argument was, if you had free trade, it would kind of force people to do the more efficient jobs in their area. So you would maybe lose some wine producers in England, but or some sheep herders in France, but you would get to a point where it's more efficient. So people would produce more than they would than the current jobs that they're doing. And so as long as you had free trade, people would be able to trade their abundance for these goods that they wanted. And because there's an extra abundance, it's cheaper to trade. And so basically everybody can get these products easier, more efficiently, and that increases their wealth if they want those or need those products. And this applies to many things, just like that. Nowadays, like a big example I would think for global wealth is the internet. When I was young, you had to send a letter somewhere to get things done. It could take like weeks before you got a reply back. Nowadays, you get mad because somebody hasn't replied to a text in 5 minutes. So generally the efficiencies, like if you have goals, you can learn how to achieve those goals, or you can communicate with people you need to get those goals done a lot faster with the internet. And so it's a huge global benefit, I think, to wealth. Now, there's also individual wealth, and to improve your individual wealth, you can, part of it is like mindset, part of it is getting a job that pays you more or whatever, but just something like a to-do list, I think is like one way you can improve your personal wealth. Like if you just have a set of goals that you're going to do over the day, over the weeks or whatever, it focuses you on achieving your goals faster. And so that, in my mind, kind of increases your chance of getting those goals achieved, thus increasing your wealth. So it's not as maybe impactful, but it's just an example of increasing wealth. So how does this apply to stocks? I think there's many investment mindsets that go into pricing stocks. And so when it comes to people like traders, they'll look for patterns. People who love a company will just like buy it for whatever price. And so all these cumulative effect of different people investing for different reasons will kind of give a real stock price. But when a stock price starts to fall, there's usually the mindset of, is this company producing something useful, like increasing the wealth of society? And if it is, then a value investor traditionally will have an intrinsic value for this company. So they'll say, like, this company is worth X amount of dollars. And just like, for example, if you looked at a farm, if you could buy a farm for $100,000 and you'd expect it to produce $20,000 of net profit every year, you'd say, okay, I'm willing to take, this, I think a risk is, or the value is pretty good at $100,000. It pays off in 5 years. Great. Now, a lot of value investors also have this mindset ingrained in them of a margin of safety. So they'll have a lower value than their intrinsic value. That's what they are willing to pay for something. So this is the same as, usually it's like, I don't know, 10, 20%, maybe more. But you'll get, if somebody thought like $100,000 is fair for a farm, if it got to $80,000, they'd be like, yeah, I'm going to buy this because, yeah, instead of paying it off in 5 years, I could pay it off in 4 years. Great. But I kind of see this as something that really sets the bottom price for stocks. So as long as a stock or an investment produces some kind of actual wealth or wealth efficiency basically in society, I think there's always going to be this kind of value of the stock or of the company. And so the lowest price is usually set by these value investors. And it's kind of what I think was happening, and it happens throughout, like if you look through historical stock prices, I think it's happening all the time. But even if you looked at 2018, where basically after February, stocks they drop and then they go up and then they drop and they go up. And you keep going through this like zigzag or sawtooth motion. But you kind of see where the S&P or Dow would always kind of bottom out at a very similar place. And so until December, in which case you kind of went and dropped off dramatically. So what I kind of think was happening was you have these value investors that kind of set an intrinsic price, I don't know, whatever percentage below the actual value of a company they think is, or stock. And then even when people are selling off in the market, you'd hit that kind of baseline. And so I think that's what happened throughout most of the year. And then in December, I think people who are down, like big investors who are down already in their portfolio, basically I think that's probably what it mostly was. There wasn't a lot of good reasons for the recession, there wasn't a lot of good reasons for the decline in the market. There's some like worries about trade or worries about slowing economies, but I kind of felt like it was something like the 1987 stock crash, where there's not a lot of good explanations of why it happened. And so I think it was more like a self-fulfilling prophecy. Like people would just say it was going to crash, and so they were just selling off because they thought it was going to crash. But you'd have these value investors basically holding the price still, and then in December there was probably a lot of them a lot of big investors who just said like, well, maybe I already lost, maybe I'll just cut my losses now, so I have a big negative year, but then can buy right back into January and stocks will shoot up, and then they'll have a good 2019. And so I kind of see that, and that's probably why I think like in December you had this huge drop, and in January you basically had stock prices shoot back up again. And now we're kind of back at that fair value, I think, for stocks. And so I wouldn't be surprised if you went up and down again in the stock market after this point. But again, like now people are back at their kind of comfortable level is what I see. And the value investors are really setting it. So, when a stock market is crashing, you're shaking out like people who invested for like love of a stock. They don't know what the price is worth at all. They don't know if the company is going to survive. So they're just like, oh, maybe I should get rid of this. Traders, they're always in there just to make a quick buck or quicker dollars. And so they might not have an actual price. So they just sell out. And anybody who doesn't have a price set to the stock, they have no idea how far down it can go. And so they're always willing to kind of just jump out even if they're down. So that just keeps like growing, and people keep selling the stocks, but it does bottom at some point, and that, I think, point is whatever that value investor thinks is correct. Now, which might be a little bit below even like their normal threshold, depending on how the market's acting. So like if it's crashing, people might say, well, I might be able to get this slightly cheaper, so I might win an extra 5% or an extra 10% or whatever, you know. So I kind of see that's what's happening in the stock market. And how can you use this strategy? So like you can look at how companies have bottomed out in these times of whatever sell-offs, and then in the major sell-offs you can look at, you know, what I've noticed is when there's a major pressure on a stock to sell, usually when you get to like 30% of its actual intrinsic value, there seem to be some pretty big value investors stepping up to the plate. So I think if you can find a company that is I mean, it's pretty hard, but if you can find a company that's worth 30% of its actual intrinsic value that you calculate, and it's not, you know, not going to have a chance of going bankrupt or running into some kind of weird debt issues, and you think the company's growing okay, then if you can find a stock at that price, you're going to do really, really well, is my opinion. But yeah, those are kind of my general thoughts on wealth and how you can kind of apply it to the stock market. What do you guys think wealth really is? And do you think there is a true bottom to these stock prices? And, you know, can you use this kind of information as an investor? I'd love to know your comments, and hope you enjoyed this kind of long-winded speech about it. But anyways, thanks for watching, and we'll see you in the next video.